Hi, I'm Rick Kaler. Thanks for joining me. Investing through an IRA is a foundational method of retirement saving. Opening and contributing to an individual retirement account isn't very hard. But that doesn't mean that IRAs are simple and easy to understand. Far from it. I was reminded of this at the 2018 Spring Conference of the National Association of Personal Financial Advisors, also known as NAPFA, where I attended a workshop by Jeff Levine of Fully Vested Advice, Inc. He spoke on 10 critical IRA mistakes. I want to cover 2 of those today. Top on his list of mistakes was failing to make charitable contributions out of your IRA when you're over 70 and a half. These are called Qualified Charitable Distributions, or QCDs. Now here's why giving to a charity directly from your IRA is a really good idea that's going to put money in your pocket. For traditional IRAs, at 70 and a half, you must begin to withdraw something called a required minimum distribution, which is known as an RMD, whether you want to or not. An RMD is taxable at ordinary income rates, and further, if you make a charitable donation today under the new tax code and you're over age 65, you must have over $13,300 of itemized donations per person to get any portion of it deductible. So by donating out of your IRA to charity, you get to reduce your RMD by an amount equal to the charitable gift, which makes your charitable gift 100% deductible and lowers your adjusted gross income. And this can also help lower your Medicare premiums. Let me give you an example of how this works. Assume that you're age 71. You give $9,000 a year to charity. Your property taxes on your home are $2,500. Let's say you're in the 22% tax bracket. Let's further assume that your RMD is $10,000, which might be close to an RMD on $400,000 of an IRA. Now, without planning, you'll take your $10,000 required minimum distribution. You're in the 22% tax bracket, so you'll pay $2,200 of income tax on it. Since you only have $11,500 in itemized deductions, which is your $9,000 contribution, your $2,500 of property tax, you're going to take the standard deduction of $13,300, right? None of that really helps you. If instead you contribute your $9,000 to charity directly out of your IRA, that reduces your RMD from $10,000 to $1,000. So you only are going to be taxed on $1,000 of an RMD, which slashes your tax liability from $2,200 to $220. Now that's a savings of $1,980, which will cover most all of your property tax. If you make a QCD in this manner, it is essential to let your tax preparer know there's no written evidence from your IRA custodian that your RMD needs to be offset by the amount of your gift. It is your responsibility to tell your accountant so that he or she will report the correct reduced amount of the RMD on your tax return. Otherwise, you're going to pay the full amount on your RMD as if you hadn't made the gift. Okay, let's look at a second significant source of mistakes. It's the complex asset protection rules on IRAs and retirement plans. Protection differs between bankruptcy and non-bankruptcy creditor action. So if you've heard that your retirement plan is protected in bankruptcy and from creditors, you're partially right and partially wrong. Now let's look at bankruptcy. In bankruptcy, all employer plans, which are known as ERISA plans, SEPs, SEP IRAs, and simple IRAs, and rollovers from ERISA plans to an IRA, like a rollover from your 401k to an IRA, are 100% protected from creditors in bankruptcy. Unlimited amount. Accounts that you personally contributed to an IRA or a Roth, those are those that say are capped at $5,000 to $6,500 a year depending on your age, have a limited protection. They're only protected up to $1,283,025. Anything over that is subject to creditors. Thirdly, inherited IRAs are not covered in bankruptcy whatsoever. So I think you can see why it's important to keep your traditional IRAs, your rollover IRAs from ERISA plans, and your inherited IRAs all in separate IRA accounts, because they're all subject to different rules in bankruptcy. Now, if that's not complicated enough, let's make it more complicated. Different rules apply if creditors sue outside of bankruptcy or in a non-bankruptcy proceedings. Now, ERISA plans are still 100% protected in all states. So your 401k at your company that you work at is perfectly protected. However, IRAs, and this would include rollover IRAs, any IRA, are 100% protected in some states and not protected in other states. If you happen to live in California, Georgia, Maine, Mississippi, Nebraska, Wyoming, or South Dakota, you may have no creditor protection on your IRA at all. Some have limited, like for example, South Dakota, you're protected up to $1 million, but some have no protection. All right. Now, solo 401k, SEP IRAs, and simple IRAs, and that solo means you're the only employee in the 401k. Those plans are protected in non-bankruptcy proceedings in about half the states. The other half, which includes South Dakota, have limited or no protection. So if you live in one of these states and have a solo 401k, an SEP IRA, or a simple, you may want to roll it into an IRA as soon as circumstances allow, because in some states you'll go from no protection to 100% protection. So, mistakes like the two that I've described here and the three more that I'll cover next week can really be costly. To avoid them, especially if your circumstances are at all complex, it's wise to get tax and IRA withdrawal advice from qualified financial advisors. Thanks for joining me.